What's up? This week, we are going to take a look at another deal. I love pulling up the Transworld website or just a broker's website and looking at deals. It's a great way to just think through opportunities, think about how you might fund it, and see stuff that's good and stuff that's not so good. So this one is an investment opportunity in a quilting shop, a quilting business in somewhere in Indiana. I don't know exactly where in Indiana, to be honest, but it's a quilting company. And let's talk about the high level characteristics, and then we're going to bust out the model, and I'll show you guys how I would think about the math on this deal. So first thing I always look at, seller's discretionary earnings, $257K a year, pretty low. Don't like that it's small, but if it's priced right, that's still interesting. Total sales of just under $1 million, so good margin, but that's also inclusive of the seller's salary. So we got to be careful about that. Assets as a whole, about 390K of inventory, 40K of FF&E, so 430K of total fixed assets. But something jumps out at me right away that I don't like quite a bit, which is the purchase price and the down payment. So this is $1.25 million purchase price, $1.25 million, and they want 100% of it as cash down, no seller financing, no terms offered, which is almost a 5x multiple on this $250K earning stream for a quilting business, a retail quilting business, right? There's a lot that I don't like about that. 5 times is a ridiculous multiple for a business of this size generally. I wouldn't pay anywhere close to that. I would even be skeptical of paying 3 times for this business, and I'll show you the math on that in a second. But to me, that's very, very not interesting. And then layer on the fact that it's a retail business, which I don't know if you guys have heard of this thing called Amazon, but retail is basically getting crushed right now. Crushed is maybe an overstatement, but generally speaking, buying retail businesses, I don't think is a great strategy unless there's some really specific reason why you think it's great, or it's Amazon proof, right? Whether it's doing some kind of service or it's food or something that people have to buy physically. I wouldn't want to buy a retail products business that the whole product suite could basically be sold on Amazon. And it's also a hobby, right? It's not something that's medically necessary or really critical. It's a hobby business in retail, and they massively overpriced it. So I'm going to show you the math on why that overpricing matters and give you a sense of how to break down deals and see why deals like this should never be priced this high. All right, I've modeled this deal up to give you guys a sense of how the economics might look in a transaction like this, right? So without going into the weeds on this model, I'm happy to explain. If you have questions, feel free to reply to this and let me know. But basically, I took the revenue, the SDE is about a 27% margin, which is decent, but it's also including the owner's salary, so it's not that decent. The asking price, which is a multiple of 4.85, which is just the asking price divided by the SDE, right? I threw in another 20 grand for working capital, miscellaneous deal expenses, to just say a total deal size, which is just the purchase price plus the miscellaneous deal expenses of $1.27 million. If we assumed we took out an SBA loan at 90% loan to value, the loan balance on that would be 90% times 1.27 would be about $1.14 million. And you would need to come up with $127,000 of equity, right? So setting aside where we would source that, let's just look at the economics of the deal. The other thing is I took the asset base right here, and I calculated what's called the airball, which is the difference between the loan balance and the total assets. The lower the airball, and you can have deals where there's effectively no airball or a negative airball where there's more assets than the actual purchase price. Those deals like that, lenders love. And oftentimes it depends on the underlying business, but those can be really good opportunities or much easier opportunities to finance because lenders like to see a lot of asset coverage. In this case, obviously, there's a negative 700K. So if you close the business down, sold all the assets, you would still be short 700 grand to pay the loan back. Not a good thing, right? The annual loan payments, these are rough assumptions, but I assumed a 10-year term and 11% rate, which is roughly maybe where SBA is pricing on the conservative side today, which is about $189,000 in annual loan payments. Based on that, if the business generates 257 grand, you pay 189 to the bank, you would have about 70K left over annually, right? Which is not great. In fact, that's not very compelling. If you rephrase that, think about it like this. Why on earth would you take out a north of $1 million loan to buy yourself a job that you can make less than $70,000 a year, right? It's nonsense. Nobody will ever do that. It doesn't make any sense. It's way too risky. It's ludicrous, right? You could go out and get a job paying substantially more than that and not have to take out $1 million loan, right? So this is ensure if you pay it off over time, whatever, your cash flows increase. But the reality is it's in an industry that's not great, that's probably declining over time. And it's also a brick and mortar hobby retail business. Terrible industry to be in, right? So this is why a 5x multiple for a business like this makes zero sense. And it's unlikely that anybody would ever actually pay that. So I went and priced this at more of a fair market value for what I think this business would actually be worth. And this also still assumes a 90% SBA loan, when in reality, I think this business would require a hefty amount of seller financing to actually make it work. But you can see it starts to get at least a little bit more compelling here. Everything on here is the same revenue, same SDE. I took the asking price down to $750, which is just under a 3x. Same deal cost, so we have a $770K total deal size. Same thing, 90% of that would be a $693K SBA loan. You'd need about $75,000 to get that deal done. And you would still have an airball, but it'd be like a $250K airball instead of almost an $800K airball in the other case. Your loan payments would be about $115,000 a year in the same loan assumptions. And you would have free cash flow of $143,000, right? So almost $100K a year more, not quite, but that starts to get more compelling. Especially when you think about if you invest $77K, right? Obviously you have the loan, but that's almost a 2x return on invested capital in terms of the free cash flow. Now, if you're paying yourself or you're taking those out as owner earnings or owner distributions, then, obviously that's not going to be a pure return on the invested equity necessarily. But either way, I think that this is more compelling. I still wouldn't do this deal, even at this price, right? And I mean, you can ask yourself, would you buy would you buy a retail quilt business even for $750,000? I probably wouldn't, right? Without re-racking this whole model, if I really were to look at this and see what would actually make sense, I would probably want the seller to finance at a minimum 30 to 40%, maybe 50% of this purchase price, right? In that case, if the seller's financing 50% of the purchase price, maybe I'm only taking out a loan that's $300,000 or $400,000, right? 50%, the seller would be financing $375,000. I'd have a loan of $375,000, of which that would be less than the asset base, right? So now I have no airball. My collateral coverage is better. I can maybe get some better terms on the seller financing, and suddenly my cash flow improves dramatically, right? We'll run these numbers really quickly. So if I say, all right, here, let me do this. I'll just shrink down this loan balance. Just say we take a $400K loan out, and the seller finances another, what is that, $350 on top of that. So we'll do some really quick math. We'll just say the seller note, assuming it's interest only, would be $350,000 times, let's say the seller, we charge them 8%, right? In that scenario, we would make $163,000 a year, so we'd have better cash flow. We would have a negative airball with the bank, right? So worst case scenario, the seller note wouldn't be personally guaranteed. You'd be in a much better spot. I still don't love the business. I still don't love the market that it's in. I don't like that it's brick and mortar retail, but $1.25 million for this business is laughable. It will never trade at that price, and no sane person would ever do that deal. This is why this fact, that all of this math is why both small deals trade at low multiples, and why you'll often see for smaller, riskier deals, you need more seller financing for the deal to make sense for a buyer. So I hope this shows you how I think about a deal and how you can use some of these tools and resources as you think through pricing deals and underwriting them.